Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. A couple of past guests worth mentioning: Darren Huang, who does commercial and residential real estate. Joey Wignaraja of 19 Days is doing some awesome work in studio venture work in Tulsa, starting new businesses and then spinning them out for commercial success. Today's episode is brought to you by Chris Lyle State Farm. Chris Lyle State Farm helps you protect your most precious assets and investments, whether it's your home and auto, investment, rental properties, or other valuables. Call Chris Lyle State Farm for a quick and painless phone call to potentially save you double digits on all of your insurance needs. Visit diallyle.com or call his office at 918-878-7771. Today's episode is also brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Walter is going to talk to us today about some of the key questions that owners ask when they're calling in our shopping hour services. Walter Bowser is the business development manager for Oklahoma City, Keyrenter, Oklahoma City. He's self-proclaimed probably the best business development manager to ever walk the earth, and that's saying a lot. He graduated from Oklahoma State University with a major in economics and a minor in entrepreneurship, and he's the father of Boston Bowser. Boom, Walter Bowser, welcome to the show. Looking good as always. How are you?
Good. How are you doing?
I'm good. I want to start with the basics. What even qualifies you to talk about any of these subjects that we're going to touch on today?
I guess my biggest qualification has been working, in the industry for the last, I would say 3 years in this role as a business development manager. And before that, I was in property management, doing multifamily management. But as we've been, kind of going through the COVID times and then post-COVID and how the market's shifted, we've seen a whole different market kind of happen over the last year. So I would say, being in the trenches and really digging in deep and doing that over the last, little bit has really opened my eyes and kind of educated me on what the current market situation is.
Yeah. So things have really changed since pre-COVID. Man, pre-COVID, we used to have these cycles where in winter things would calm down, and then in summer they'd ramp back up and we'd do all of our leasing, and then in winter they'd calm back down again. And it was really great for our property management team because they could actually take a breather after a long summer. And then during COVID, it was like craziness straight through. We would expect some sort of dip in December and people would just keep leasing properties. And because rates were so crazy, our owners were buying properties. So we had more properties to lease and people were still renting. It was insane. But hopefully now we kind of get back into a standard cyclical nature of property management, where our property managers can actually breathe a little bit after the high peaks of summer. But to your point, you've seen a bunch of market shifts over the last couple of years, pre-COVID, COVID, and now kind of post-COVID. What are you seeing in terms of those changes over the last, let's call it year, let's call it 12 months since July, more than 12 months now, 16, 18 months since July of 2022 and rates started creeping up? What have you seen in terms of shifts in the market?
Yeah, absolutely. I mean, recently in the rental market specifically, we've seen the propensity to spend for the average renter just tighten and kind of, shrink up as interest rates and stuff gets more expensive their car payment might go up because of interest rates and all these other things that the economy is squeezing. They're looking for a better rental rate, along with there's a lot more options on the market right now. For example, during COVID, you could put up a property at, basically 10% over what it would have been previously, and it would have been snatched up rather quickly.
Yeah.
And now it's shifted to where, there's more options on the market. And so, the consumers has more options, number one. Number two, they're more budget conscious now that rates have higher. It's just more expensive right now, especially with inflation as well too. And there's not as much money in the pockets of the average American as there was 2 years ago. And so we've seen that they're more conscious about their budget. So we're not able to have that, super aggressive pricing on the front end that we might have had, way up high. We needed to be more, conscious of what, the consumer's looking for and have a better approach that way.
But so that's interesting. There was a period during COVID where owners would come to us and they'd say, you think this would rent for insert $200 above market? And we'd say, I don't think so, but I can try it. And lo and behold, we put it on the market for $200 above and it would go. And now that's just not the case anymore. And I don't quite understand. It seems like employment levels continue to be super high. And yet the average renter is being squeezed. They're willing to pay a little bit less. And I don't really understand it. I think tech jobs have laid off. The big tech companies have laid off, I should say, and those people have been absorbed by other companies in the market. They may have taken a slight decrease in their salaries. But the average person, it seems, if you're just a blue collar worker, if you're a plumber, if you're a sheetrocker, any of the trades, you might, even though you're fully employed, you might just be seeing wage increases that are a little bit lower, or maybe you're not getting all of your hours because your employer is a little bit fallow, right? I mean, there's not as many new construction starts. So all those little things, I guess, kind of trickle down into the economy. And that's where we're seeing the average blue collar worker just getting squeezed a little bit. Does that seem right to you?
Yeah, absolutely. I mean, not only that, and it's great because Oklahoma's full of blue collar workers, especially Oklahoma City, and I think we're really flush with that, and it's great, especially since it's a market and we're in the rental, management business, and there's plenty of renters in the Oklahoma City market. But you're 100% right, and I think it just goes back to maybe a little bit of now people are more conscious about the economy and where it may be going, and maybe they're like, hey, all these propaganda of a recession coming, that we're a little bit more scared to spend more money on rent, right? So they're like, hey, yeah, exactly. So last year I loved being proved wrong. I would come in and say, hey, I think that here's the rental income for this property. This is what I would price the home at, and the owner would push back sometimes and be like, hey, I actually think that, for example, we had a property in Norman, Oklahoma, that I priced it, probably around $2,500, and they're like, no, we can get $3,600 for it. And I was like,
oh my God.
I don't know if that's possible. And so she's like, I won't move forward with you as Keyrenter unless we can at least try it. And I was like, okay, we'll give it a try. And lo and behold, we got that $3,600. How that happened, not quite sure, but there was someone in the market for it at that time. And now we're just not seeing that level of, let's put it up there and kind of see what happens and see if it sticks.
The question is, what happens when that tenant goes to renew? Are they going to be willing to pay $3,600 again, knowing what else is on the market? Now they may say, I could go and get the same house for $3,100. Is it worth renting? It's going to cost me $5,000 or $6,000 to move, and so it's not worth it. But you probably are not going to be able to increase pricing on that person the same way you could have from 21 to 22, for example, right? That would be
absolutely
a big jump.
Yeah, with this specific situation, we don't know yet. They signed a 2-year lease, so we don't know yet. But and the condition could be a little bit different whenever we get to that next year. I believe is when the lease is up. But for example, we just aren't seeing that really anymore. This last 3 months, we had another property in Norman. I don't keep going back to this, but it was a much larger house than that one that we talked about earlier, and we got much under, or well under, what they thought that we could get for it. It was more on our guidelines of what we could get for it, and so we weren't able to. But that just shows that there's really not that. People are being more budget conscious moving forward.
I guess the truth is that your ability to spend today is the present value of your future cash flows. So if you think that you're going to make less money, or if you think that prices are going to continue to go up and you need to budget for that in the future, you just have a sense and a feeling that things are constricting, and therefore you pull in your horns a little bit. As my grandfather used to say, you stop spending now because you're afraid of what the future can hold. And that's, I guess, is borne out by the idea that so much of our economy is based on consumer spending. And if consumer spending stops and the economy grinds to a halt, and that's why the Fed wants to keep the sentiment of people high, or in this case, when they're elevating rates, they want to bring it back down to reality so that people have the feeling that it's riskier to spend and therefore stop actually doing it. But that leads us to a really good point. Our owners borrowed more money. Oftentimes they paid more money for a house because interest rates were lower and they could afford a higher value of a house on the monthly payment basis. They were getting a little bit more money, so their cash flow was a little bit healthier each month after they rented it. But what are we seeing now? I guess we're seeing now prices are a little bit lower potentially for houses that are being acquired. However, it's made up by the fact that their monthly payment at 7.5% or 8.5% interest is higher. And so their cash flow would be constrained. So when people are talking to you about our property management services, what are you telling them in terms of, the standpoint of folks looking to buy now?
Yeah. So when we have an investor come in, I think that it's really adjusting, what their goals are and having that kind of tougher conversation with them. Especially as you see, some investors come in and they might not be as educated. It might have seen like, hey, get rich quick through real estate, or whatnot, and having those qualifying conversations, or what I would say is education conversations, or whatnot, because there's a podcast that I listened to, and it was like 67, so like 2/3 of people really don't have any idea of what property management is, or really what real estate is coming into it. So having those educated conversations with them is really healthy, and maybe saying like, hey, it might not be the right play for you if you're looking for a ton of cash flow at this moment. It may be more of, hey, we can get this property for lower than what the asking price is, and maybe what the appraisal would be, and it's a more of a long-term hold until conditions are different in the market, and we're holding this for appreciation, or
Right.
for example, tax purposes. If they're a high W-2 income earner and they're needing to do depreciation or whatnot, depending on what really suits them well. But if they're coming in immediately looking for cash flow right now, the numbers just aren't there. It's really tough, and kind of moving away from an investor standpoint. I know you asked a question kind of looking at an investor standpoint, but with the accidental landlord kind of situation, because we have a lot of those in Oklahoma City, especially with the military base here, and a lot of people getting relocated that bought in this last 12 months when we saw the interest rates starting to creep up. They come to us and they're like, hey, what can my property rent for? And that's a super obvious question, right? Like everyone should get that. I'm sure everyone in the industry gets that. But I think our answer has had to shift in a way to where, we're setting very clear expectations before we enter this relationship with them, because we want to be clear, like, hey, this is what the real estimated value of your rental would be, and that your mortgage payment doesn't dictate the rental market.
Right. Let's dive into that for a second. If somebody, and we've been saying this for years, honestly, because the historic example before the interest rate rises was Mr. and Mrs. Owner, just because you put your house on a 15-year amortizing mortgage instead of a 30-year amortizing mortgage doesn't dictate the rent price. There could be two houses. Forget for a moment that there are really no identical houses. That's why we do a comparable market analysis and a comparable rental analysis. But if you had two identical houses in a subdivision that was newly built, and one person put their mortgage on 15-year amortization schedule and another put it on 30, the 15-year amortization schedule would be, I don't know, $200 or $300 higher, for example. That doesn't mean that the person next door is going to rent their house for $200 or $300 higher. That also covers the mortgage. The market dictates it based on anybody that's willing to rent it. So if the person that's at a 30-year mortgage says, I only need $1,500 to cover my mortgage, and the average rate's $1,675, but frankly, I don't really care. I'll put it for $1,550. All of a sudden, that 15-year amortization person just got their house cut in half. Just had some rental price potential cut off the property, off the property that we're talking about. So that was historic. That's what we said. Now we're saying there's no way, even if you're both on 30-year mortgages and one of you's on a 2.75 rate and the other's on a 5.5 or 6 or 7% rate, that does not at all dictate what the market will bear for this rental property. And that's a tough conversation to have because people don't think about it like that. They want to make money in real estate and they want to cover their mortgage. Obviously, if they're trying to make money, they're covering their mortgage. But I guess the conversation then has to shift to you're paying down principal a couple $100 a month. That's one way you make money in real estate. You're putting cash in your pocket every month. And at some point in the future, you can actually take that cash out with a refinance, which is a tax-free savings plan in essence, right? And that's just it's a difficult conversation to have with people. And it's hard to make them understand that we cannot rent the property based on their mortgage rate. It has to be based on the market.
Yeah, exactly. And you're 100% right. It's such a tough conversation, but it's one that has to be had, especially for, setting those expectations. And it comes back to, if it's a really, really tough conversation and the client or the prospective client is, really putting a bunch of pushback, it might not be the right fit for us.
Yeah.
Just because we know that we're not going to overpromise because that's how we get unsatisfied,
Right.
clients. And then it sets up a headache for our operation side of things. And so it's really kind of a balance beam, I guess, and that essence, and making sure that, we're having the tough conversations up front. So we're not, having a really, really tough conversation on the back end or, having someone really upset in the back end.
The question is, do you want to have the tough conversation? If you're an owner, do you want to have the tough conversation up front and price your property appropriately? Or do you want somebody to say, yes, ma'am, yes, sir, it will rent for $300 above the market and let it sit for 2 months? If it's a $2,000 a month rental, it should rent for $1,700, $300 in a month, you lose $1,700. That's a significant chunk of your annual income. There's an inflection point where you can say, we should have just rented it at $1,700 and gotten it done a month or two earlier, and we would have paid for all that time sitting on the market.
Yeah, really good point. And it's such simple math that it's really easy to explain. And if you put that in front of a logical thinking person, it's more of like, okay, this makes sense in a long scheme of things. And that's kind of why we have those, owner updates on a Tuesday, making sure that we tell them, hey, this is how the property is marketing and why if we're being super aggressive on prices, why we might need to drop it twice a week instead of just once a week. Because we don't want to lose that precious time, because like you said, that's money you never get back.
Never get back. And if there's a person in the market at $1,399 and we've got the house priced at $1,500 and we're going to lower it anyways, the person that was in the market at $1,399 is already gone. They've already found a home.
Yeah, exactly.
So if an owner does think that their property is worth $2,000 and we're indicating that it's worth $1,700, is there anything that he or she can do to increase the value of the rental?
Yeah, I think there's some really qualifying items to maybe rehab or update depending on the property. Was it a new build or was it a home from 1970 that there's some things, and if they're willing to put the money into the property, I saw that just as simple as if you have hardwood floors, resurfacing them is almost has like, I can't remember where this is from, I wish I could quote it, but it had like 100% return on investment if you were just refinish the floors. And it's not that expensive to do, but it's something that you immediately walk in and see and prospects look, and it's just little things like that you can do to upgrade. And I'm sure you probably have some other ideas on that, but really it's good for us to go into the property with the owner and have that walkthrough on situations like that, and we can identify and kind of know the market trends on what tenants are looking for. For example, an updated kitchen, or curb appeal, just having a steel front door that's safer and better for efficiency and stuff like that, can go a long way, and it's something that could help you boost that rental income on the property.
A couple of things that you mentioned that are worth kind of digging in deeper. One is, or reminds me of the broken glass syndrome. If you walk into an apartment complex or a house and there's a broken bit of glass, then you think, well, I can throw my trash here, I can break other glass, I can do whatever. And that's, that leads to greater wear and tear on the property over time. Not good. If you can avoid, if you can finish the flooring, the hardwood floors, for example, and you can avoid other people coming in and just scratching it and being like, oh, it's already scratched, who cares? Then that's long-term operationally more efficient for your property. The same goes for painting walls and doing other stuff. The second thing is that tenants will ultimately feel the total cost of renting, just like you know the total cost of ownership of your vehicle. If you buy a Toyota or a Lexus, you're going to pay less money over time than if you buy other models of cars. And that's borne out. You'll do less service, less maintenance, maybe synthetic oil changes every 10,000 miles instead of an oil change every 3,000 miles. And you get it. When you go to buy your next car, you'll think, do I want a lower total cost of ownership? Well, the total cost of renting is the efficiency of the windows, the efficiency of the door, as you said, whether there's a threshold sweep, whether there's all these things. And a tenant that's in a property after a year and says, my rent is $1,500, but my utility costs are $600 a month, will understand inherently that they're paying $2,100 a month when they could be paying, a similar situation. They could pay 18 plus 300 or 17 plus 300, and they're saving $100 a month because it's a more efficient house. So if we can do a couple of those upgrades, they sometimes seem foolish on the front end, but what happens is, or to an owner, sometimes they don't understand the ROI, but what happens is that their tenant turnover will be lower. Every time their tenant turnover doesn't happen, they save money on painting and flooring and a bunch of other stuff, not to mention the vacancy period and then paying another leasing fee. We encourage owners to keep the tenants in the property. And sometimes that means we don't raise the rent as much. We always like to raise rents because it encourages tenants to understand that rents go up every year as our owners' expenses go up. But sometimes we, want to stay flat or keep the increase relatively low. But I think it's worth saying that tenants will understand the total cost of renting, and we shouldn't minimize that point.
Yeah, it's a really good point, especially and really it comes up a lot during the walkthrough when we're having those in-person meetings with these clients. Is exactly what you said. Is if they walk into a property and it's looking great, it's in great condition, they're gonna know that, hey, this is the expectation to live here. And setting that first initial expectation, I actually had a client ask me the other day, hey, do you think it's worth the $50 to have my lawn mowed before the tenant moves in? And I said, absolutely. That $50 is going to turn into far more, return on your investment than you think, because they're going to move into that property. They're going to see the lawn's taken care of. It's green. Right. It looks good. And they're going to be like, I need to keep it this way. And right. That's the expectation when you said it there. And a lot of people don't necessarily understand that, but if you have that conversation with them on, hey, this countertop is not level, or I'm making something up, but it's sure. Let's make it look nice before the tenant moves in, then the expectation is set, and hopefully it's like that for their entire stay. And your point is absolutely correct, is let's keep them in there as long as possible. There's definitely a cost analysis on raising rent versus the tenant moving out and doing the whole turnover and having the property ready for rent again. And it's important to have that with the client as well too.
I mean, the tenant that walks into a property where the paint is not done properly and the flooring is scratched up will accept that condition, and the person that's willing to accept that condition will also treat things that way. Whereas a person, if you lose the tenant that says, no, I'm not willing to accept this in this condition, they're probably the tenant that would keep things in nicer conditions, because people will live ultimately in the nicest place that they can afford. And so they're more likely to kind of tear it up. What are some other questions that you're hearing from owner prospects when they're inquiring about our property management services these days?
Yeah, I would say another one is what is the time frame to get my house rented out? And this one has been kind of an interesting conversation for me recently, because like we said earlier in this conversation, it was a lot quicker, especially over the last the previous 2 years, just because there wasn't as much on the market. If you look on the
Sure.
on the rental market right now, there's just so many properties online, and it's because, well, probably a few reasons. One, money was cheap, so a lot of people were entering the investment world and buying rental properties and getting them online. And now two is accidental landlords or whatnot that were wanting to keep their property, or they can't sell them right now because of the interest rates, and there's less buyers in the market, and people can't qualify for the specific home they want. And what I've kind of seen is, if you can't qualify to buy the property that you would want to live in, then they're not gonna go and buy a less nicer house or a less quality house. They're going to go buy or rent, excuse me, a house that they want to live in. Does that make sense? I mean, I don't know if that makes sense. And so, um, uh, what we've seen is that we're trying to kind of gauge, like, how long will this property sit on the market. And of course, you're taking in time of year and the amount of comps in the area that are currently on the market. And so we want to set the expectation with the potential client of, hey, this is worst case scenario. Hopefully it's within that 4 to 6 week range is where we're kind of seeing right now. But if we're pricing it correctly within the comps that we're seeing, we should be within that window.
Yeah. The tough market out there. It's a tough market for everybody. Where do you envision rents going and prices going in the future? I know nobody's got nobody's got a crystal ball, but do you have any thoughts on where rents will be in 12 or 18 months?
I think it'll be, right now the kind of standard in Oklahoma City is right around hovering $1 per square foot. I think that we'll be over that just because as properties continue to go on the market and people have to hit certain numbers for it to make sense, and people will adjust that. And of course, there's always different, cash buyers or people that have bought these homes from, the previous years when numbers weren't there. But of course, they're going to want to get the top dollar for rent as well too. I think it will have to continue to rise. I think at the rate it was, absolutely not. I think maybe a 2% increase over a year, I think is probably more realistic than what we were seeing previously. What are your thoughts on that?
I guess the good news is that you have interest rates, sustained high interest rates mean, as you said, fewer people can buy houses. And so they'll continue to be renters, and that increased or that sustained demand will continue to push properties up or rental prices up. And then as more people continue to buy at higher rates, it will naturally force what they need to make for the investment to make sense up. And even though that doesn't dictate the price, there will just be more people that are trying to get higher and higher rents and fewer people that are willing to keep the rents where they were. And again, as you said, a cash buyer or somebody that's in a lower interest rate will naturally look at other comps and say, that one leased for $1,700. I'll try 1,710 or 1,715 or whatever it is. And so that will continue to kind of push things up. But yeah, I mean, there are new housing developments that are coming online. There are new apartments coming online. And so there is continued inventory, but I think that there are more ingoing tenants because of the rate increases. So I think prices will continue to come up. And, through the 2007, 2008 dip in Oklahoma, it was a very minimal, shallow, if any, decline in any sort of pricing. And that was a much more severe downturn when the liquidity crunch hit the banks. And so if everything goes the way it has historically, which is never the case, but could be some indication of our future, prices. We didn't have such inflation. We didn't have such inflated prices to begin with, such that we'll see huge drops in either the price of purchases or the price of rents. So that's my thought. Walter Bowser, business development manager from Keyrenter, Oklahoma City. He is self-proclaimed probably the best business development manager to ever walk the earth, and that's worth noting. He's a great guy, a great father to Boston, and a great business development manager. If you've enjoyed listening to this show, you can reach out to Walter at KeyrenterOKC.com. He's a graduate from Oklahoma State with a major in economics and a minor in entrepreneurship, and that's a big battle in our team between the Sooners and the Cowboys. So there's if you have one opinion or another, call Walter and chat about college football. Walter, any final thoughts before we wrap up?
No, not really. I absolutely enjoyed the conversation. And absolutely reach out to me if you have any questions or are looking to invest in the Oklahoma City market. It's still strong, still a lot of opportunities to invest. either buying or if you're putting your property on the market as an accidental landlord kind of situation. Would love to help you out.
Cool. Thanks so much for your time. Appreciate you.
Absolutely.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.